Back with closing trades right here in 80 now and still lying absolutely flat in trade. Quiet consolidation after taking that all-time high for both the Nifty and the Sensex yesterday. 26,376 right now. The Nifty futures and M&M has been that one strong hand from the word go. 2% higher, 3750 plus levels for M&M. Other than that, some of the Adani names are holding out well. So Adani Enterprises, Adani Ports, both those names gaining over 1%. In fact, Adani Enterprises is almost notching a good 2% of a gain. SBI has had a strong, move today. That's holding up about almost 0.6% or so. And other than that, Reliance has petered down a little bit. TCS is flattened out. So is the case with HCL Technologies. And yes, lots under pressure as well, be it in SBI Life, Shriram Finance, BEL, Bajaj Finance, the big mover from yesterday, Axis, Interglobe Aviation, Trent and Bharti. These are all laggards as well. But Nirav Sheth joins in on the show right now to talk about what he's making off the market. Nirav, hi, afternoon. Great to have you on the show. Nirav, what's the way forward now that the all-time high has been done with? Do you think a few more days of consolidation up ahead, or do you think come January when the earnings kick in, one is bound to see more upside to the current markets?
So it's obvious that markets will make more new highs. Sometimes we just don't know the timelines to it, right? So every day when you get up in the morning, your GDP is slightly higher than what it was at a new all-time high. The profits are largely at an all-time high every day as we move forward. It's just that the markets don't try and move in a linear fashion. We had a reasonably good correlation, time correction, so as to say. And please appreciate the fact that we are one of the worst performers as far as the global markets are concerned, right? So some of your peers are up 60, 70% in dollar terms. You are virtually flat. And I think that, so both the things, that the earnings are catching up in Q3, Q4, and the valuations are looking far more reasonable. So good times ahead.
Okay, so that's your take on the market right now. Nirav, now that all-time high has been hit on the Nifty, should market participants or investors be looking at purely large caps as a safety net, or is there more value and a more run-up that you're seeing in the broader end of the market?
We've been generally more constructive on the broader markets, right? So if I look at the earnings for the narrow market or the Nifty, then we are still looking at somewhere in about 12 or 13%. The expectations are of 15% next year. While, and obviously you can't paint the same color all on a large broader market, but there are a lot of the sectors within the mid cap space, in the small cap sales where the earnings are compounding at more than 25-30%. So India is a delight market if you are trying to work with a broad level of sectors and stuff like that. You got manufacturing, you got platform companies, you got this EMS companies. There is a whole solar chain over there. So to answer your question, the broader markets are looking appealing as well.
And then, of course, Nirav, there is the strong appetite in the primary market. I mean, one can't really crib about flows not coming in because all the flows, I guess, are getting diverted there. Sign of exuberance, you think, or it's just one should read it as the market broadening up?
See, I think if you look at, for example, if you look at Germany, right, that also a very typical market that, you got very, very small companies specializing in very few sectors, niche sectors. They're not globally scalable companies, but very strong in their respective sectors, niche sectors. I think there's something on similar lines is playing out in India, but obviously on a scale which is 10 times, 20 times larger because that is the size of the economy, right? Are there pockets of exuberance? It is always the case, right? But we don't know, right? So you can't necessarily try and say that, the markets are getting overvalued. I'm not a great believer of that. For example, we talk about the fact that, there's an AI bubble. It's a very profound technology. Valuations can be ahead of the story. You can argue that. I hear about this narrative about Lenskart. No one puts a gun on your head and asks you to go and subscribe the shares, right? So it's a free market. There is supply, there is a demand. This is a very, very good thing for India. Access to many larger companies, and the fact that, if you meet a lot of the promoters, which we do, there is a preference for equity over debt for whatever happened in the last 10 years. So there's money into the economy, and that's a very, very welcome trend.
Right, but Nirav, you did mention Lenskart, and I can't help but notice the kind of subscription that Lenskart saw versus the listing it saw. Compared to the IPO that listed today, I don't know if you've tracked Sudeep Pharma, 94 times oversubscription and also listed at a premium. Do you believe this ratio or the trade-off that we're seeing between subscription and the listing is justified the way the trend has been so far?
No, I'm not a great believer in that. I think if you're in the market, if you're a market participant for a long period of time, a lot of these GMPs are to some extent even they can be managed, especially for very smaller issues. And I'm not casting aspersions on anyone over there. But when you talk of very large cap market companies, you have to believe that there is a lot of efficiency in terms of how the issues are priced. This is essentially demand supply situation. So I would not wager the opening pop-up that you get based on the level of subscription that you get. You need to have a sense of intrinsic value of the company at the end of the day.
Understood. But Nirav, any of the recent IPOs where you've recommended a subscribe?
No, I don't want to necessarily get into individual stocks, and not that I've studied. I'm just making a very generic comment, and I am a believer of the market efficiency. So I was just replying to the point that you made that there seems to be an over exuberance in the IPO, and I don't necessarily buy that argument. So it's a very vibrant and healthy market, and that's very welcome. And I'm hoping that I'm not giving a biased view, because obviously we brokers benefit from the tailwind.
Okay, fair enough, Nirav. But let's just focus to the secondary market and once again talk about the biggest constituent or the sector that's done most of the heavy lifting in that all-time high that we've scaled yesterday, and that has to do largely with financials, both your banks and NBFCs. Are you seeing further run-up in this space, or do you believe that the exuberance here is over and now maybe we could be seeing strength in some other sectors?
No, so I believe that the current round of the market leadership in the Nifty will be taken by banks, because obviously you are coming off a cycle which is poor credit growth in the last year. You've seen fair amount of repo cuts. We believe that there'll be more repo rates to come, hopefully starting next week. And therefore, you will see revision in terms of the credit growth rate, in terms of NIMs, expectation in terms of earnings growth rate, and the valuations are very reasonable. Within that space, I still believe that NBFCs will lead the rally. They've been leaders of the rally so far, and largely because the growth differential between banks and NBFCs is large, and the divergence in ROE also seems to be narrowing. Most of the larger ones, you talk about Aditya Birla Capital, you could talk about Larsen Financials, they're doubling the book every 3 years, which is 25% CAGR, with an ROE about 15-16%. So that's great.
Right, and Nirav, speaking about rate cuts, what are you making of the GST cut that we've seen? Do you believe that it's about time for the impact to start playing out? If that's something we could see in Q3 itself, or will that take a little bit longer?
It's already played out in Q3, but don't try and think of this as an episodic 1 quarter, sort of event. The fact of the matter is that for a lot of these sectors, you had a significant increase in the prices, running far ahead of the increase in per capita income. To that extent, there's been a balance between affordability and the prices right now. And therefore, for at least some of the sectors where you're far more optimistic is two-wheelers and stuff like cars, especially the lower end of the cars, we probably believe that you'll have a better volume outlook for the next several years. And I also want to make a point, and this is very unlike most of the world. In India, we just don't, we are not very keen in terms of taking price actions based on how the macro environment is playing out, right? You've seen enough, go abroad and Tesla, every time there's a slowdown, Tesla is willing to take a price cut and try affordability. Thankfully, government is playing the role over here, but that will change as we move forward.
Right. But Nirav, what about the entire consumption fillip or boost that the government has been, sort of pushing? Do you think that's going to translate materially into earnings and thereby then PE as well?
So on the discretionary side, I think it will matter into the earnings because at least our belief is that the volume elasticity is more than the price cuts, right? So over a period of time, that is certainly an accretion to earnings going forward. If you're looking at, what you call the fast-moving consumer goods space, the benefits are far and few in between. But again, there are valuation concerns over there. So at least personally, I am not a big fan of trying to play the likes of, Nestle's and Hindustan Levers and Asian Paints of the world. I think that there will be long-term laggards in this bull market.
On the flip side, Nirav, how would you play the consumption space? Would it be via discretionary or would it be via autos? What would your play be here?
Yeah, very clearly autos. So I think you got penetration on your side. Now you've got the GST kicker that comes in. Very, very strong competitive mode for a lot of the companies, very well established niche that each of the guys are going to play. Quite like those space. I also like cement, for example. The stocks are not rallied at all, right? And I believe that cement is where telecom was 3 years back, and lot of consolidation, inherent pricing power is there. None of them are going to do anything right now because you're in 1 or 2 quarters of these GST cuts. Wouldn't look good to try and take price increases, but they have to come if you take a year out. And therefore, those are opportunities, I would say.
Nirav, so great to have you on the show. Thank you so much for your time today.
Pleasure. Thank you.
Okay, on that note, let's take a very quick break. When we come back, we'll continue our market discussion with our other experts.